countries. Why the oil production started to decline from mid-2000? It mainly reflects those kind of maturing oil field in major oil producing countries. As you may know, there has been a discovery of major oil field in 1970s and 80s, but after around 20 to 30 years, the production from those major oil fields reach their plateau and start to decline. So that reflects, that those kind of pattern is reflected in this stagnating pattern of the global supply. Then do we have to be very pessimistic about this oil supply perspective? We are not that much pessimistic, but not optimistic. As you can see, since around mid-2000, the supply of oil respond to those kind of high oil prices. As you can see in here, which show the total rig count by region, show that there has been strong increase of those investment activity, which is good sign for the oil supply. And as you can see also on the right hand side, the following very sharp increase in the kind of investment cost for this oil and gas industry during the Great Recession period, there is somewhat decline of this kind of investment cost. So we expect that the supply are now responding to high prices, and once those kind of investment activity are linked to the delivery, the supply side will kind of improve to some extent. But as I mentioned before, there is really long implementation lag in this kind of mineral industry, especially oil. So we don't expect that this kind of additional supply will come on stream in the near term. And the current stagnation just reflects the legacy effect from this kind of low investment in mid-80s and mid-90s. Then the next question is, then what is the implication of this kind of oil scarcity in the global economy? To understand this, how much will the impact, we did some kind of empirical analysis, simulation analysis, using the IMF so-called GIMP model. This is very complicated, but dynamic stochastic general equilibrium model, which has been used quite extensively for many different purposes, including G20 discussion. We just extended this model to capture this kind of oil component in this model. So in here, this is standard 60 region model, but we include oil exporters as additional region, and then we enter this oil as additional production factor and the consuming factor, and then the elasticity of the demand and supply is calibrated as we estimated before, and I'll skip all those kind of things. And one of the important assumptions that we made here is that following those kind of oil scarcity, maybe when the oil price rises, those kind of additional oil rent from the oil exporters' point of view will be saved by those kind of the government. And instead of using all of those kind of oil money in any single year, they're gonna keep all those kind of money in the US dollar asset, and they're gonna use that at the annual rate of 3%, which seems to be a very reasonable assumption. And then I'll just skip this slide. And then this is, due to our time constraint, I think I can show only this slide. Our benchmark scenario assume that there will be some oil scarcity. In what sense? For at least for last 20 years, since around 1985 to 2005, world oil supply has increased by around at the rate of 1.8% annually. However, as you can see, there is some stagnation of oil supply since mid-2000. So for this exercise, we assume that, okay, what will happen if the oil supply growth will decline to 0.8%? So 1 percentage point decline from their pre-crisis trend. So if there is 1% substantial decline of 1 percentage point in the oil supply, what will be the impact? Definitely oil supply will decline for the next 20 years. And according to this analysis, oil price will sharply increase by around 60% in a single year, and persistently will increase up to around 200% in the next 20 years. This kind of overshooting in the first period mainly reflects the very low price elasticity of demand, because the demand elasticity is very small, very low. When there is this kind of big oil supply shock, oil price will rise very sharply by around 60% according to this analysis. So in that case, the real absorption or domestic demand of those oil exporting countries will rise very sharply because their income and wealth will increase. However, according to the exercise, their GDP is expected to decline up to by around 3% in the medium term, around by 5 years. Why? First one, definitely the oil supply is declined substantially by 1 percentage point. So there is big factor there. Another one is this kind of strong growth of the domestic demand will be another big source of the domestic price pressure. In that case, that will lead to very significant appreciation of their real exchange rate. So their tradable goods sector, excluding this oil, will be hit very hard by this kind of rapid appreciation of their real exchange rate. So due to this kind of low oil supply, oil production, and then the real appreciation of their currency, the real GDP for these countries is projected to decline by around 3% in the medium term. However, as the government spending start to kick in, as they start to spend their kind of oil revenue, additional oil revenue, this impact will be somewhat mitigated going forward. And then the current account definitely will improve substantially, reflecting mainly this kind of high oil prices. But the impact of this kind of high oil prices or lower oil availability to oil importers will be definitely the decline of their GDP. However, the size and the relative size of different regions has different implications. As you can see in here, the domestic demand of all different oil importing regions will decline substantially, reflecting their lower oil availability, and so their oil balance will deteriorate quite significantly going forward. However, as you can see in here, real GDP, especially in emerging Asia and Japan, are projected to actually improve during at least for the first couple of years, reflecting those two important factors. First one is, as I mentioned before, there will be a strong import demand from oil exporting countries. And according to the current economic structure, emerging Asia and Japan are the main exporters to those oil exporting countries. So reflecting those kind of strong demand growth, importing demand growth from oil exporters, those increased export will somewhat more than offset those kind of decline of GDP for emerging Asia and Japan. However, in the long term, definitely their GDP will decline, and then in aggregate, as you can see on the top left panel, the world GDP is expected to decline by around 3% in 20 years, which means that roughly around 0.25% annually. So 1 percentage point decline of the oil supply expected to decline, it will reduce the world GDP by around 0.25%, which seems to be quite benign effect. However, we do not want to take this effect. And okay, I have to mention another second factor. Sorry. On top of those kind of trade linkages, due to those kind of huge amount of kind of oil revenue from oil exporting countries, and as I mentioned before, we assume that those governments in those countries will save those money in US dollar asset. Those kind of huge amount of saving will lead to those decline in global interest rate. And according to this according to the simulation, according to the scheme model, in 20 years, the global interest rate is projected to decline even by around 100 basis points. In that case, due to this kind of lower interest rate, the region which has some more component of investment, especially emerging Asia and Japan, where the investment to GDP ratio is higher than any other region, will be benefited from this kind of lower interest rate. So due to this kind of strong export linkage to oil exporting countries and the benefit from this kind of low interest rate, emerging Asia is expected to benefit a little bit in the medium term, but eventually GDP will also decline quite substantially. However, as an aggregate, as I said, impact will be quite limited. And I just skip this implication of the current account. However, we don't want to take this benign effect as granted. Because there are tons of uncertainty in this analysis and also in the assumption. And for example, if we assume that price elasticity of demand is higher than what we assume in here, that means that if there is more scope for the substitution away from oil, then we can expect, as you may expect, the impact on the current account or GDP will be around half of what we see in the benchmark cases. However, another worst case scenario that we want to mention in here is, instead of assuming that oil supply will decline will increase by 0.8 percentage point, which is lower by around 1 percentage point compared to the benchmark, there is a strong argument, so-called peak oil proponent, saying that the world oil supply already plateaus and will start to decline at the annual rate of 2% from very near term. So if we take that assumption, if we assume that instead of growing by 1%, 1.8 percentage point as in the benchmark case, if the oil supply actually decline at the annual level 2%, how much will be the impact? As you may imagine, impact will be quite huge. The price will go up by around 80% in the 20 years, and then impact on the GDP or the current account will be quite huge. However, we expect that the impact will be even more than this, because as you can see in here, we have never experienced those kind of oil price which is higher than this by around 800%, which means that definitely there will be some another non-linear effect in the global economy. And as you can see in here, according to this kind of linear simulation, the global interest rate will decline by around 4%. But if that happens, for example, in a lot of countries, nominal interest rate will go below zero. So in that case, there will be some less scope for the monetary policy, something like that. So under this kind of more worst case scenario, the impact can be even more worse than this. So we just want to emphasize that even though we expect we generate some benign impact of this oil scarcity scenario in the benchmark, we do not take that for granted in going forward. Let me just skip this one. So, for example, if the oil contribute more to the production, definitely the impact will be much higher. Okay, due to the time limit, let me just quickly summarize what I've mentioned before, what I presented. So, based on some real long-term price information, we understand that global oil market has entered a period of increased scarcity, but under the baseline, on the benchmark scenario, this can gradual and moderate increase of oil scarcity will have only benign impact on the medium-term and long-term growth. However, there remains significant potential for severe impact. And then what should be the policy implication? First one that we emphasize is that the policymakers should review their current policy framework to see whether those framework is enough to facilitate the adjustment to these unexpected changes in oil scarcity. All our simulations assume that there will be smooth adjustment of the natural or the economic resources, for example, the labor and the capital. So in the short term, for example, if due to some frictions in the market or rigidity in the market, so if the reallocation of resources are not happening as we assume in this model, definitely the negative impact can be much large. So we recommend that policymakers should facilitate this adjustment, especially they have to strengthen the role of the prices. And then as a more long-term kind of policy agenda, they have to start to think about the policies aiming at lowering the risk of oil scarcity itself, including some development of sustainable alternative energy sources. So let me stop my presentation here and turn to other discussants.